Hey all, okay, Mr. Vashon here. This is going to be video 1E for the course. Video's going to be on revenue, expenses, and drawings. I'm going to say over here. What this video is basically about is just going to be an intro to what revenue, expenses, and drawings are, how these are going to become accounts, and basically what we're going to do here is we're going to take the equity section, which currently we only have one account in when we're doing like T-charts and trial balances, and we're just going to make that bigger. Instead of just saying equity, we're now going to add an account for revenue, an account for expenses, and an account for drawings. Going to go over how we debit and credit them and just do some examples here. Okay, I won't get into income statements or anything like that. So learning goals. Number one, explain how revenue and expenses relate to owner's equity and transactions. And number two, you're going to practice recording some transactions where revenue and expenses and drawings are going to be in the ledgers. And I'll show you what a updated trial balance will look like. If you feel good right now about the ledgers, then I think you're going to feel pretty good about this one. So in this video, I'm just going to do a quick review at the beginning of what we have been doing for owner's equity related transactions. Number two, we're going to go over what these are, go over a couple new gaps as well in the middle, revenue, expenses, and drawings. Number three, just do some practice at the end. So to start things off, we're going to do a really quick Ed puzzle problem here. What I want you to do is just quickly answer, how would you post the following to T accounts to this point? So I just want you to tell me in this little question, what do we debit them? What do we credit them? Okay, give that a shot. Okay, so taking this up really quickly, this is what we have been doing. Right now, if we were to say that for number one, a customer pays 300 cash to our business for services rendered, well, what you would do there is you would go to our cash T account and you would say, okay, we have an increase in 300 cash, so we're going to debit cash for 300 for account number one. And currently, what you would just do is you would go to the owner's name, we'll say the capital account, and you would say, okay, well, this is going to increase the value of our business by $300. So capital increases. So we're going to credit that for 300. And we put transaction number one. When it comes to questions like number two, our business pays 250 for monthly utility. Well, you would credit cash for 250 because if we're paying this money, we're losing cash. And we would also say that the value of our business is kind of decreasing by 250. So in this case, you would debit capital. Okay, number three, if the owner withdraws 2,700 cash from the business, you would go over here. You would decrease our cash by crediting it for $2,700, and then you would similarly just decrease our owner's equity. So what you're seeing here and what we have been doing is rather than getting specific on what type of capital account, we've just been saying capital in general. Okay, this part over here is going to stay the same more or less. The other side, whatever we're also debiting or crediting, but we're going to start calling number one when we're collecting money, revenue. We're going to start calling number two when we're paying money for business expenses. We're going to create some expense accounts. And number three, we're going to create an account called drawings. Okay, when we're taking money out of the business. And that's basically what this video is in summary. Okay, so let me now jump into it a bit. So this is what we're going to basically add, just a little summary there. So far, we've just been using the capital account to record changes in equity, but in reality, we want to get more specific. So we're going to be using multiple accounts, okay? We're going to do revenue accounts to record things related to the sale of goods and services, expense accounts to record costs that the business is incurring. That's going to help us generate revenue, things like, telephone bills, wages, things of that nature. Drawings, we're going to look at as well. So we're just going to add a drawings account when we take money out of the business. Instead of just debiting owner's equity, we're going to now debit the drawings account. And for capital, we're just going to keep that capital account. That's why I put it purple here. But yeah, this is what we're going to record transactions related to things like investments and just capital gain losses. Maybe something related to a change in the value of well, actually, we'll take a look at that a little bit later. So just moving forward, not to make it too confusing right now. So far, again, assets equals liabilities plus equity. And we're going to learn right here that when we are doing transactions that involve equity changes that decrease the value of our equity, expenses, and drawings, that's going to be a debit because we're going to always decrease the value of owner's equity. Therefore, we want to have a normal debit for expenses and drawings. And when it comes to capital and revenue, these tend to be things that increase the value of our business, such as an investment in capital and revenue, money coming in. So since normally we've already been crediting that, we're going to say that when there's revenue, we credit it. When there's an expense, we debit it. When there's drawings, we debit it as well. Okay, so let's do these one by one. So I'll do an example, then I'll just show you some important things. Then you'll do an example for each of revenue, expenses, and drawings. So first, revenue. So as you might already figure out, revenue is money earned through the sale of goods and services prior to expenses. Okay, if you need to calculate revenue in broad terms, what we do is we just multiply the price of something times the quantity sold. The idea is if a bundle of bananas is $2 and I buy 6 bundles of bananas, 6 bundles. This is the quantity sold, and this is the price per unit. So here the revenue would be $12. Okay, very intuitive, very simple. Revenue increases the equity of a business. Okay, so theoretically, when a business is collecting money, the revenues carry a normal credit balance, right? Because as we've learned, when the equity of a business increases, what we've been doing so far, we would credit capital. Okay, so if we are collecting $12 as a business, just forget about the bananas for now. We're just doing service businesses. We would simply credit for $12. Okay, what we're going to do now is we're going to change that up, and we're going to create an account within the equity section called revenue, and that's what we credit. So let's do this example very quickly. So Eva Bates is a lawyer. She draws up a legal agreement, so service business, for John Day, one of her clients, for her services. She charges a fee of $250 that's due in 60 days. So how would we record this transaction on Ledger T account? Well, what's changing? Well, the first thing that's changing is an account receivable. Okay, for Mr. Day here, and that account receivable is now going to be going up by $250. So we're going to debit it by $250, and we'll record our transaction number over here. But here, instead of crediting capital, we're going to create an account called revenue, or actually, in the case of service businesses, we're more often going to call it fees earned. Okay, so the fees earned here are $250. And revenue is an equity account, so it makes sense that we are increasing equity by crediting it. So revenue is going to be a default credit. I hope that makes some sense. Just another little quick term concept before you do an example of your own is going to be the revenue recognition principle. Before that, just wanted to show you sort of what I just did. Just imagine your normal ledger. Okay, this is what the capital section is going to look like now, though. Okay, so whereas before we had just this one big account of capital where we recorded everything, now we're going to break that up and we're going to have a fees earned T account right here. And as you can see, when we record something under fees earned, we're going to be crediting it. Okay. More on that in a little bit. And the last little thing here to know about revenue is just the first of two gaps in this video called the revenue recognition principle. And what this says is that revenue must be recorded when it is earned and not when cash is received. Okay, we have to record revenue in the month it's earned and not when cash is received. So you might have been thinking in that last example I just did over here with Eva. Well, why are we recording revenue now if we're not going to actually get the money for 60 days? And the reason is when it comes to revenue, the revenue recognition principle does say that we have to record revenue when it's earned. Okay. So we're actually doing what we're doing to earn the revenue right now. If you're not sure if the revenue is being earned now, you can ask questions like right here. And we're going to go over these in class a little bit more, but these will just help you. And what we want to say is basically, is our business doing what it's doing to earn the money from this customer right now? Like, has the service been provided, or if they're buying a good, has the good been delivered? As long as we can say it's reasonably certain that the customer will pay us back later, then we can just record it. Okay, so I want you to do an example right here. This is the first you try. Give it a shot. All right, so let's record this the proper way now using a revenue section. So here we have $900 in services being performed, 600 cash now. Okay, so we are going to be debiting cash for 600 since we're increasing it. We're going to be paid back the remaining 300 within 60 days. So our account receivable here for TRZ will also be debited for $300 because we're going to get that back later. And the answer for our revenue, we're going to say fees earned here, is going to be $900. Okay, note that with 300 of it, according to the revenue recognition principle, we're not getting back yet. So if instead you put down 600 under fees earned instead of 900, that's not correct because we're earning the full 900 now. The revenue recognition principle says even though we're going to get paid this 300 back later, we still have to record the revenue this period, this month, for example, when it's earned. So we record the revenue right away as long as we're reasonably certain that we're earning it. So the next two will be a little bit quicker. Expense accounts first. Already sort of been through this, but expenses are the costs of doing business. This is what businesses have to incur on a daily basis to help earn revenue. So at the beginning of the course, when you were introduced to liabilities, you might have said, well, what if we just have to pay a phone bill, for example? If we pay it right away, that's an expense. Expenses are necessary, but obviously owners try to work to limit expenses because an expense simply decreases the value of a business, like in that opening example. And what we do with expenses is we debit them. Why? Well, because if we have to do something like pay money that has for like a phone bill, for example, and we're not getting any assets in return, that, as we've learned before, will decrease capital. So if we have to pay $500, we've been recording it like this, decrease the capital. That's why any kind of expense, which also decreases capital, needs to be recorded as such. So Eva Bates pays her administrative assistant the regular weekly wage of $900 using cash. Okay, so what we're going to do is we're going to create different expense accounts for each one because that helps accountants figure out where money's being spent. So we're going to create an account called wages expense, and anytime we pay wages, we're going to debit this account for $900. Okay, so this transaction here should be expenses get debited by 900, and what would our credit here be? It'd be cash. Cash decreases by 900. So we have a credit of 900 to cash and a debit of 900 to wages expenses, which is going to effectively bring down the equity of our business. So I hope that does make sense. One more quick note, as you can see here, we're just going to have different accounts for all types of expenses. If it's a wages expense, like I just did, it'd be right here. If it's a car expense, pay to repair a car, for example, it'd be $615. Advertisement, if we have to pay that, $1321. So we're just going to create different accounts, as you can see, for each different type of expense to help us track it. The matching principle, the last gap in this video, the matching principle expenses must be recorded, accrued when they are incurred and should be matched at the revenue they help earn. All right. So what this basically means is that if we have an expense that helps us earn revenue this month, even if we pay back that expense later, we have to record the expense this month. So it's sort of like, in a way, kind of the opposite of the revenue recognition principle. Okay, so given that, keeping that in mind, I want you to try these ones right here. Give it a shot. Okay, so number one, just asks you to record this transaction. What would you record for today, July 31st? Well, July 31st, we received a bill for $110 worth of telephone services that helped us earn money in the month of July. So this is our July telephone bill. That means that we have to record this in July because the matching principle says that this telephone bill helped us earn money, do business in July. So we have to record the expense today. We can't wait until August 20th when we pay it back to record it, because if we record the expense on August 20th, then it's going to make people believe that this expense took place during August. Okay, we'll talk about that more when we do income statements. So basically, the answer to this one will be quite straightforward. For July 31st, okay, we're going to have an account payable is going to increase by $110 because we now owe $110 to them. And we have we could say telephone expense, okay, will be debited of 110 because expenses get debited. Okay, so I hope that makes sense. And again, number two, when we pay back the bill on August 20th, at that point, all we're going to do is we're going to credit the account payable. That'll be our second transaction. So because we've now paid it back, the money we owed them, which is cool. And then cash at this point, cash will decrease by 110. So this will be the August transaction. Not that you had to answer that, but yeah, it'll be account payable will decrease and cash will decrease. But as you can see, the expense was recorded in July because that's the month that helped us earn money. Okay, so we're going to wrap this up. We just have one more to talk about very quickly is drawings. This one's pretty easy. So just like expenses, we're going to debit drawings because just like expenses, drawings will decrease the equity of the business. It's just money going out of the business. Okay, so they're not counted as expenses because they don't help the company earn revenue and they have nothing to do with determining net income or net loss. So expenses help us make money, earn revenue. Drawings is just money leaving the business to decrease equity. All right, so drawings are like expenses, but they're not quite expenses. Therefore, they have a normal debit balance because, again, they're decreasing the value of the business. So this example down here, if Eva Bates now withdraws $1,000 from her business for personal use, what you would have done before would of course be to credit cash for $1,000 because we're losing 1,000 in cash. Before you would have debited capital, but now you're not going to do that. Now we're going to have an actual drawings account and you're going to debit that instead of $1,000. So this is a type of owner's equity account that has the same effects. I hope that makes sense. And just try a quick example of this. Okay, and there's your answer. Just to quickly check it out, just like the last one. Okay, so just to summarize this video and wrap it up, I just want to show you that if these are your T accounts, your trial balance changes too, but no surprise here. So on the left, this is what a trial balance has looked like for you before. As you can see, capital, you just have one capital account, but the whole point of this video is to extend the capital account. So instead of just having capital, which now might take the form of really just investments for the time being, we're also going to add our other T accounts that we've now made. So we have a drawings account, we have fees earned for revenue, and we have our expenses. So we usually put it in the order of capital, drawings, revenue, and expenses. Revenue and expenses go in alphabetical order. All right. So I hope that makes sense there. So all we're doing is we're just taking our T accounts and instead of just putting capital on the trial balance, we're now going to put the individual accounts. We've now learned about drawings, fees earned, and the expense accounts. Okay, and as you can see, the expenses have a debit balance, the fees earned have a credit balance, the drawings, of course, have a debit balance because drawing and expenses decrease equity, and fees earned increase equity, as does capital in this case. All right, and just to summarize, you can pause it here if you want to, just to look at this picture. This is a summary of how drawings, expenses, and revenues work in terms of debits and credits, but we've been through that. To end this video, I want you to try the examples from the beginning, but this time to do them correctly. Okay, and there are your answers drawn out in transactions. Please let me know if you have any questions about why these answers are the way they are. So just look at transaction 1, 2, and 3. Okay, thank you so much for sticking with this video. Here are the learning goals one more time. Hopefully you feel a little bit more comfortable with transactions. And awesome. Have a great day. I'll see you all later.